Welcome to Zitron's Squeeze, where Oracle's numbers deserve a much harder look. Oracle's story right now sounds simple if you only read the hype. Huge AI demand, huge data centers, huge future. The harder question is whether the business underneath that story is actually getting stronger, or whether scale is masking fragility. Start with the long arc. The claim here is that Oracle has been in decline for at least a decade and has stayed afloat mainly by acquisition rather than organic growth. The concrete number attached to that is more than $85 billion spent on acquisitions over 23 years, with those deals serving as the main thing keeping revenue from going negative. That doesn't automatically mean the company is broken. Acquisitions can be a real strategy, especially in mature enterprise software, where switching costs are high and growth is hard to find. But it does change how you read every growth claim. If reported growth depends heavily on buying revenue instead of creating new demand, then the headline looks healthier than the core engine probably is. And that's where the criticism bites. If the underlying business is flat or shrinking, acquisitions stop being optional expansion and start functioning like life support. One reason Oracle got the benefit of the doubt for so long is that it had a genuinely unusual track record on free cash flow. From 2001 through the pandemic, Oracle generated positive free cash flow every single year. In tech, over that span, that kind of consistency is rare. Then FY 2026 lands at negative $23.69 billion, the first negative free cash flow result in 25 years. That is not a rounding error, and it is not a normal wobble. It means something fundamental changed in the capital demands of the business. The strongest supported explanation in this set of facts is the AI infrastructure build-out. If a company with Oracle's cash profile suddenly goes deeply negative, the burden is on management to show this is a temporary investment phase with credible payback, not a structural deterioration. The scale of that investment is staggering. Since mid-2020, Oracle reportedly spent roughly $99 billion on AI GPU hardware. For context, that one recent spending wave is almost double the company's prior 9-year capex total of $50.4 billion. So the issue isn't whether Oracle is investing aggressively. It plainly is. The issue is whether this is disciplined capacity matching real demand or a debt-fueled race to avoid missing the AI cycle. You can see the financial stress around it. Net debt reportedly rose from $56.9 billion in FY 2017 to $167.4 billion in FY 2026, alongside that free cash flow swing deep into the red. There's a reasonable bullish interpretation here. If Oracle locked in long-duration demand and can keep utilization high, these assets could produce years of revenue and make today's numbers look like a front-loaded build phase. But the bear case is also straightforward, and, on the evidence here, impossible to dismiss. GPUs and data center capacity are expensive, financing costs matter, and if customer demand slips or pricing weakens, the downside arrives fast because the fixed costs are already committed. That brings us to the wildest claim in the whole stack, that Oracle pledged to build 7.1 gigawatts of data center capacity for OpenAI as part of a reported $300 billion 5-year deal. Even before getting into accounting or financing, the physical scale is the first reason analysts call this implausible for a single client. Then there's the economic side. A contract of that size would imply annual costs above $70 billion for OpenAI. Based on the facts given here, that looks far beyond what the startup could realistically afford. So there are really two separate questions. First, is the reported scale literal and firm, or is it a headline built from softer commitments, options, or assumptions about future usage? Second, if the obligations are real, who actually bears the risk when the economics don't line up? Oracle would be exposed to a huge amount of capital spending against a customer whose ability to absorb those costs is far from obvious. The key discipline here is not to confuse strategic association with financial certainty. Saying Oracle is aligned with OpenAI is one thing. Proving that the resulting revenue will justify the infrastructure bill is something else entirely. The Cerner deal is a cleaner, less speculative example of what acquisition-led growth can look like in practice. Oracle paid $28.3 billion for Cerner in December 2021, turned it into Oracle Health, and added roughly $6 billion in annual revenue. On one level, that's real scale. Revenue is revenue. But the margin profile matters. Oracle Health reportedly runs at about a 21.7% margin, well below Oracle's traditional software margins, which helps explain the office closures and layoffs aimed at improving profitability. This is the trade-off in a nutshell. Buying revenue can stabilize the top line, but if the acquired business is structurally lower margin, then investors eventually ask whether the company is getting bigger in a way that actually makes it better. And healthcare IT isn't a trivial plug-in business. It's operationally messier, more service-heavy, and harder to make look like classic high-margin enterprise software. The sharpest critique comes from forensic accountant Howard M. Shillett, who has characterized Oracle as a well-documented example of using accounting techniques to mask a declining core business. The important distinction here is that the source material does not allege simple fiction. The concern is presentation, acquisition-driven revenue and inflated margins, creating the appearance of healthier growth than the underlying business would show on a cleaner basis. That matters because, in a mature company, narrative management can buy a lot of time. If investors focus on reported revenue, adjusted margins, and strategic AI positioning, they may miss that the quality of growth is changing. The fairest conclusion from the facts here is not that every Oracle number is untrustworthy, it's that the company has multiple incentives to frame decline as transformation. And investors need to separate durable operating improvement from balance sheet-fueled expansion. Right now, the strongest confirmed facts are the acquisition dependence, the massive capex spike, the debt increase, and the collapse in free cash flow. The least settled part is whether the AI demand story is strong enough to make those choices look prudent in hindsight. Oracle may still pull this off, but the burden of proof has gotten much heavier. That's it for Zitron Squeeze. This episode was generated by Podkey. Create your own at podkey.fm.